At first glance, the idea sounds impossible. How could a 1% tax possibly fund the entire federal government? Most people naturally compare 1% to our current tax system. But the receiving tax is not built on the same foundation. The question is not whether 1% can replace today's taxes. The question is whether 1% applied to a much larger monetary base can generate sufficient revenue to fund a constitutional federal government. Let's start by looking at the current system. Today, the federal government primarily taxes production and ownership. We tax income. We tax payrolls. We tax business profits. We tax capital gains, and many other forms of economic activity. In 2024, the federal government collected approximately $4.9 trillion in taxes. Yet, despite collecting that enormous amount of money, it still borrowed approximately $1.84 trillion in a single year. The result is a national debt approaching $39 trillion and still growing. In simple terms, we have built a system that takes too much, borrows too much, and leaves the bill to our children and grandchildren. This proposal approaches funding from a completely different direction. Instead of taxing production and ownership, the receiving tax focuses on monetary receipts. On the left side of the chart, you can see some of the major monetary systems through which money moves every year. These include Fed wire transfers, foreign exchange settlements, securities markets, ACH networks, card networks, business receipts, and many other forms of monetary activity. Together, these monetary flows represent an estimated $3 to $4 quadrillion moving through the economy annually. Rather than imposing high tax rates on a narrow base, the receiving tax applies a 1% rate to this much broader monetary base. 1% of $3 to $4 quadrillion produces an estimated $30 to $40 trillion in potential gross collections. Whether the final number is higher or lower remains to be validated through measurement and testing. But the concept is simple. A very low rate applied to a very large base. No IRS, no federal tax returns, no business tax filings. A fundamentally different approach to funding government. One of the most common questions is how the tax would actually be collected. The answer is surprisingly simple. When money is received, 99% goes directly to the recipient. 1% is automatically directed to the Treasury collection account. No forms, no tax returns, no annual filing requirements, no additional action by citizens or businesses. Collection occurs automatically through the banking and settlement system. Once collected, every dollar has a purpose. The receiving tax is allocated to specific constitutional priorities through the Treasury Pillars framework: national defense, infrastructure, foreign affairs and border security, debt reduction, Social Security and Medicare transition funding, financial system integrity, federal operations, administrative oversight, and the Federal Stability Reserve. The goal is transparency. Citizens should be able to see where government revenue goes. Government should be transparent. Citizens should remain private. A reasonable question is what happens if revenue exceeds the amount needed to fund government. Under the Pillar Integrity Principle, excess capacity can only be used in three ways. First, to reduce the receiving tax rate. Second, to accelerate debt reduction. Or third, to increase the Federal Stability Reserve. The purpose is to prevent endless expansion and keep government aligned with its intended responsibilities. The receiving tax is not presented as a final answer. It is a framework for analysis. Its assumptions should be challenged. Its methodology should be examined. Its results should be measured. And its claims should be validated. That is why our guiding principle remains simple. Measure first. Validate second. Implement last. To learn more, visit fixyourgov.com or read Fixing America's Broken Government.